Now let's move to financial statements. $69 marks for 41 minutes. We have information relating to Tatiana Traders Limited. Tatiana Traders Limited is a South African company with authorized with an authorized share capital of 10 million ordinary shares. Authorized shares is just the maximum number of shares that a company can issue. For grade 12 level, a company may not issue shares that are more than authorized. There was no capital raised from authorized. The only way to raise capital from authorized is to issue those shares. Now, when authorized shares have been issued, we say that they are issued shares. Issued means we have sold those shares. In return, we got capital. We got money. Shareholders have the shares. We as the company have their money. They source fabrics from local producers and sell them to the public from their various stores. In addition, they provide a sewing service that makes customized outfits. They add a standard markup of 200%, that is worth highlighting, on cost of all goods. Their latest financial year end is the 29th of February 2024. Now, they gave us an extract of balances or totals from the financial statements on the 28th of February 2023. I need you to note that these balances will be balances at the beginning of the year because our current financial year is the 29th of February 2024. That means 28th of February 2023 was the beginning of the financial year, which is the end of the previous year. They didn't give us our ordinary share capital. Instead, they gave us the average price for those ordinary shares, which will be 6.25 per share. But they gave us a question mark when it comes to your ordinary share capital. Something here will help us calculate that. We've got retained income from the previous year. We've got shareholders for dividends from the previous year. Now, that is very interesting. Here, they're telling us what these shareholders for dividends amounted to per share. So these were dividends issued, final dividends issued in the previous year, and they were issued at 25 cents per share. Now, for us to get that 1,875,000, we took the number of shares that were in issue at the end of last year. We multiplied that by 25 cents, and it gave us that 1,875,000. Then we've got our accrued expense for February 2023, which is water and electricity of 12,400. We might need to read adjustments just to check if we need to reverse that or not. Okay. Now, here we are given the extract of balances or totals from the pre-adjustment trial balance for the year ended 29th of February 2024. This will be the end of the current year. So this balances are for this year. We've got trading stock, debtors control, provision for bad debts, SARS income tax, which is debit. These are provisional payments. We have SARS, we've got loan, we've got deposit received. That one goes to trade and other payables as deposit received. Even though it's for rent, it doesn't affect our rent income at all. We've got creditors control that will go to trade and other payables. And then we've got sales and cost of sales and debtors allowances. I'm going to stop right there. What I'm going to do is to check if I have those values in my pre-adjustment, in my statement of profit or loss, as a matter of fact. And let's see, I've got sales, but they did not subtract debtors allowances from sales. So I'm going to do that. These are debtors allowances that we take from the pre-adjustment trial balance. The first thing you do is to subtract that from your sales amount. Okay. Brackets are closed there. That means we might not have any adjustment affecting sales. Okay. We've got additional information relating to shares for the year ending 29th of February 2024. These transactions have been recorded. Yeah. Do we have share capital? No, we don't. Okay. I don't think we even have our ordinary share capital note. So we know that on the 31st of May 2023, the company issued another 1.5 million ordinary shares, raising a total of 11,175,000 in ordinary share capital. Remember, we had share capital from last year, but we were given only the share price, but we are not given the number of shares. They're telling us that in addition to those shares, the the company issued an additional 1.5 million shares, which was it's March, April, May, 3 months down the line, they issued more shares. And then towards year end, just 2 months towards year end, the company bought back 500 ordinary shares at 800 cents each from the estate of a deceased shareholder. I don't like reading for nothing. So what I'm going to do is to check which question here requires shares, and it'll be this question here. They want us to calculate the weighted average price. This is what I call APPS, average price per share. That's what they want us to calculate. For you to be able to calculate this, you need share capital at the beginning of the year, divided by the number of shares at the beginning of the year. And we don't have any of those two. And this is the only information they gave us about shares, all right? And they said all these transactions have been recorded. The only note that can link the two is your retained income. It shows us about the buyback of shares. It'll show us the loss due to buyback. And there was nothing here. Yeah. What do we have to do now? I need the number of shares or share capital. How do I find it? Did you notice that they gave us shareholders for dividends for last year? And they told us that to calculate shareholders for dividends, whatever we had as a number of shares, we took that, we multiplied it by 25 cents, and it gave us final dividends for last year, which amounted to 1,875,000. Amazing, isn't it? You can manipulate that to find the number of shares that were in issue at the end of last year. How do you do that? You just have to remember 25 cents is the same as you multiplying by 25, you dividing by 100. This will be equal to that 1,875,000. And that can be written as 0.25x is equals to that 1,875,000. Divide this by x. So you will take that 1,875,000 and divide it by 0.25. It'll give you the value of x. X here represents the number of shares that were in issue at the end of the previous year. Or you can simply say the number of shares that were in issue when we declared final dividends. And final dividends are declared at the end of the year. So basically, those will be the number of shares in issue at the end of the year. You got it. Now take that 1,875,000. Divide that by 0.25. The number of shares that were in issue at the end of the previous year amounted to 7.5 million. Now, to get our ordinary share capital at the beginning of the year, you're going to multiply that by the average share price at the end of last year. So you will take 7.5 million and multiply that by 6.25 rand. It'll give you your share capital at the beginning of the year, which is 46,875. You can now calculate your average price, right? By simply taking that share capital and dividing it by the number of shares that were in issue at the beginning of the year, which will be 7.5 million. Remember, we issued more shares. We issued 1.5 million shares, which resulted in us raising around 11,175,000. And that will affect our average price. You only focus on the number of shares that were in issue before the buyback. And that includes those shares that were issued in May. In the numerator, you'll have 11,175,000, which is the capital that was raised by issuing 1.5 million shares. So in the numerator, you've got share capital. In the denominator, you've got the number of shares issued. This will give us our average price of 6.45 rand. This 6.45 rand is our average price. What do we use the average price for? You will use that to calculate the buyback of shares that will be recorded in your ordinary share capital note. So that 6.45 will be recorded in your ordinary share capital note. You with me? The buyback is sort of like it affects three accounts. It affects your retained, let me just say, it affects your ordinary share capital at average price. It affects bank at buyback price. Your average price here obviously is 6.45 rand. Bank, we need to check the statement to check what this was bought back for. These shares were bought back for 800 cents, which is equivalent to 8 rand. We bought back shares, guys, at a price that is more than our average price. If that is the case, it means we incurred a loss, and our loss will be the difference between these two amounts. And that'll be 1.55 rand. That'll be a loss. A loss will be taken to retain income as such as a loss, guys. You got it. Ordinary share capital at average price. If the buyback price, that amount goes to bank, or you can take it to the buyback of shares in your cash flow statement. That will be the amount that goes to the buyback of shares in brackets. It's an outflow of cash. The difference is a loss, and that loss, because it's a loss between the owner and the business, it'll go straight to retained income. It doesn't go to the statement of profit or loss. The average price represents the amount that we actually received when we issued these shares. Buyback price represents the amount that we paid to get the shares back. So we received less than what we paid. That's why we are making a loss of 1.55 rand. That loss will be recorded in retained income. You will take it and multiply it by the number of shares that were bought back. I wasn't aware that I have already done this calculation. Otherwise, I wouldn't have done it there. So for us to get the loss, you're going to take that 1 rand 55 and multiply it by 500,000 shares, and that will give you a loss of 775,000, which will be recorded in your retained income note as the repurchase of shares. Remember to show workings in brackets. Okay, I just want to put that amount there, which is your interim dividends. Guys, when you have dividends in your trial balance, pre-adjustment trial balance, just know those dividends will be your interim. So whenever you see dividends there, just know that those will be your interim dividends. So don't be surprised that I started with your interim. I don't like it when they say paid, because it confuses you guys when you get to the cash flow statement, because you assume that dividends paid will just be your interim dividends. No, I prefer for them to say these will be your interim dividends, because dividends paid is different. Dividends paid will be interim for current year plus final for last year. Those will be dividends we pay in the current year. So the company only pays 2 dividends in the year. It'll pay last year's final and this year's interim. Because last year's final was shareholders for dividends, and it was in trade and other payables. It was a current liability. It makes sense that we need to pay it. Otherwise, it will be a non-current liability if we didn't pay it in the current year. And we pay our interim. We declare and pay interim. Now, someone might say, no, sir, you're wrong. We pay interim dividends and final dividends for this year. No, we don't pay interim dividends and final dividends for this year. We declare them. It's just that interim is declared and paid. Final for this year is only declared. It will only be paid the following year. For this year, we will record it as a current liability. Got it? Guys, this thing is easy. Now, let's calculate your repurchase of shares. You will take that 101 rand 55 and multiply it by 500,000. It will give you a loss which will be 775,000. Okay, I'm done with shares now. Cheers to that. Okay, let's go to the first one. Additional information and adjustments that still need to be taken into account. We've got an amount of 14,000 is still owed by a customer for a number of outfits that were sewn for her in February 2024. So they sue clothes for this customer, but we have not received money from that customer. Therefore, we have provided a service, but we have not received money for it. That service we have provided qualifies to be income. So what you're going to do is to go to your income, and which is your fee income. You will just add that 14,000. It's income. We perform the service for it. Okay. It's just that it was not paid. The customer did not pay for the service, but because the customer did not pay for the service, we say that service is still owed to us. Therefore, it needs to go to trade and other receivables as accrued income. All income receivable. Easy peasy, right? Trying to make this easy for you guys. Okay, accounting, it's very, very easy. It's bala prada subala ubala. Now it says here the bookkeeper had forgotten to reverse accrued water and electricity expenses at the beginning of the year. The water and electricity account for February 2024 has been received and not yet paid. Okay, that is a different story. I'm going to start with the reversal first. Reversal means when you reverse it, remember when you recognize this accrued expense last year, you actually debited water and electricity last year, and then you credited accrued expense because it's a liability. Accrued expense, it's an expense that we have received a service for, but we have not paid for it. When you go to varsity, you only reverse the accrued expense part, the liability part, because it should be paid. However, at high school level, you're going to reverse the entire thing. So to reverse the entire thing, you're going to debit accrued expense and then credit water and electricity. It means your current water and electricity bill has been overstated with last year's water and electricity bill. So you're going to go to water and electricity and subtract that 12 12,400 and then subtract it from your accrued expense. Where do we find accrued expense? We find accrued expense in trade and other payables. So you will subtract it as it was for last year. It's no longer accrued. It was a current liability last year. Current liability is a liability that lasts only for 12 months. This one can't be here because it's for last year. We have exceeded 12 months. Got it. It means it was paid. Easy. Okay, let's read the second part. What does the second part say? It says water and electricity account for February. Now, this one is addressing water and electricity for this year. Has been received and not yet paid. Another accrued expense. Now, how much is this water and electricity? They say it is 25% more than the account for February 2023. It's more than the one that we just reversed. So to get it, you will simply take that 12,400, multiply it by 100% plus 25% because it has increased by 25. You add it to 100%. How much will this give us? It'll give us 15,500. That is accrued expense for this year. Because it's accrued expense for this year, we have to debit the expense and credit accrued expense. Because this expense was not recorded, it will not appear in the pre-adjustment trial balance as it was not paid. Therefore, we need to add that amount to our current year water and electricity expense in the statement of profit or loss. At the same time, this expense, we have received the service, we used water, we used electricity, but we have not yet paid for it. And that qualifies to be an accrued expense. And since it's an accrued expense, it will be recorded in trade and other payables. Why? In trade and other payables, we record current liabilities, the services we have used, we have not yet paid, we owe it. It's a liability to us. Okay, so we need to record it as a liability. We owe somebody, we owe the municipality that water and electricity bill for February. It's an expense, it's a service that was received in the current year. Hence, we are going to add it to our accrued expense. 15,500. All right. The business had forgotten to pay the 3-month advertising contract of 64,500 for the period January to March 2024. Interesting. So our financial year starts here, right? 1 March 23. It ends here in Feb. 28th of Feb. 24. No, it ends 29th of Feb, 24. Right? You agree? So it ends here 29th of Feb, right? And then, so this is our current year, correct? We took an advertising contract in January. So it'll be 1 Jan, right? 24, right? It'll carry us until when? Until 31st of March, right? 2024, correct? So it's supposed to last us for 3 months. So the problem is that of that 3 months, 1 month, what did they say here? Until March. Okay. 2 months fall within, 1 month fall outside. Okay. So it's 1 month that falls outside and 2 months fall within. So 2 months fall within. But for this entire period here, the bill was 64,500. A payment was made on the 27th. Oh, that's where the problem is. A payment was made on the 27th of February 2024 but had not been recorded. Oh, interesting. Because it was not recorded, it means this amount was never added to advertising. So you're going to take that and multiply it by 2 and then divide it by 3. It will give us advertising for 2 months. That advertising for 2 months must be added to our advertising expense because it was never added, because it was never recorded. So advertising expense will be that 64,500 multiplied by 2 divided by 3. How much does that give us? It gave us 43,000. This has been paid, so we credited bank. However, we also credited bank with the amount of advertising that was paid for the following year for March, which is that 164,000 times 1, that's 64,500 times 1 and divided by 3. 3 is because it was for 3 months. It'll give us advertising for 1 month. That 1 month was paid for next year. That is a prepaid expense. Where do we record prepaid expense? In trade and other receivables. Because we have prepaid, we paid for an expense that we have not yet used, so it is owed to us. The overseas service, they must give us our money back. Got it? Is this done? Oh, number 3, in the back. Done. The bank statement downloaded on 29th of February 2024, which is the last day of the current financial year, revealed the following, which still needs to be recorded. So all of this was not recorded. Bank charges will be 890. We will debit bank charges, meaning we increase in bank charges as an expense. We'll add it to bank charges. We credit bank, but there was no cash and cash equivalent here. So we don't need to record the credit part. All of these credit is bank, by the way, because they are from the bank statement. Interest on the current account amounted to 3,200. Interest on current account. Current account is a savings account. Savings account is a favorable bank balance. Interest on favorable bank balance is income. It's, however, not recorded with other types of income, because it's sort of like financing. It's recorded at the bottom of your statement of profit or loss. We record it there as interest income. We added to that 58,400, which was already there. We added because they told you it was not recorded. Don't ask that question. And obviously there we're going to credit interest income and then debit bank. Bank was supposed to increase by that amount because it's interest on a positive bank balance current account, favorable balance savings account. Okay. Now, a debtor had made a direct deposit of 7,500 to settle his account of 8,000. Oops. Now, guys, understand this. Bank plus discount allowed reduces your debtors control. Remember this from grade 10, general ledger debtors control account. On the credit side, you had bank plus discount allowed. Exactly. So you're going to take that 8,000 straight to trade in other receivables and subtract it from your debtors control. Don't even think about it. It's just like that. Now you can think about other things. We paid 7,500 instead of 8,000. That means the other one was a discount. This is a debtor, by the way, that is paying us. We gave a debtor a discount. When we give a debtor a discount, what type of discount will that be? Allowed or received? It is allowed. How much will it be? Do we record discount allowed? Oh yeah, we do. And it's in income, expense, and expense. We're gonna record it here as discount allowed. You add it to 32,500. We good? Away. A company had incorrectly recorded the February debit order for insurance as 6,900 instead of 9,600. So it means our insurance has been overstated. And to correct it, we need to minus the difference between 9,000. Wait, for insurance as this. No, actually, we understated. We need to increase our insurance by the difference between 9,600 and 6,900. What we're going to do is to correct this mistake, we are going to go to our insurance and just add the difference, which is 2,700. Difference between 9,600 and 6,900. Happy. I'm glad you're happy. Now, goods that would have been sold for 18,000 were returned to a credit supplier. So these goods were returned to a creditor. They were damaged, that's why they returned to a creditor. But here's the thing, guys, when we return goods to a creditor, we don't return those goods at selling price. Think about it. A creditor is someone that we're buying from, guys. You can't buy from them at selling price. To them, it's a selling price, but to us, it's the cost price. When you buy, it becomes a cost price. We would have sold them for 18,000, but they definitely did not sell them for 18,000. How much did they sell them to us for? You're going to take that 18,000 and multiply it by 100 and divide it by 100 plus the markup, which was 200. Where do I get this 200? I'm surprised I still remember this. It's right at the beginning. Remember I told you? There it is. This will give me the cost price of goods returned, right? The cost price of goods returned. Let me see. 18,000 divided by 3. It will be 6,000. So we're going to go to the creditor's control, right? When we get to the creditor's control, we're going to subtract that 6,000 because it represents goods that were returned to the creditor. Got it? And then you're going to, oh, I forgot this. You're going to go to your trading stock because these goods were returned to a creditor. It reduces the value of your trading stock. So trading stock in the trial balance is currently sitting at 8,670,000. Yo, guys, I'm behaving just like you here. Can't say numbers. 8,670,000. You're going to subtract that 6,000 worth of goods that were returned to the creditor. We don't have those goods anymore. Why? Because they were returned to a creditor. And then it says the supplier charged Tatiana Traders Limited 150 for collecting the goods. Oh, that's an expense. Collection fee, or you can call it repackaging fee. You will put it as an expense. All right, it's your expense. We pay for this expense. The answer is, let me just read. The answer is they did not mention that we paid for it or not. Therefore, it means we did not pay for it. It increases what we owe the creditor. You will add it here as 150 rand. Still happy? Great. We're done with that. Number 6 says that provision for bad debts must be decreased to. Oh, that word is very important, guys. This word here. If it was buy, that 95,200 will have been income. But because they said to, it becomes our final provision for bad debts. If they said buy, it was going to be a difference, which would have been an income because it was a decrease. You getting it? Yeah. So what do we do with the final provision for the current year? You don't even think about it. A lot of you guys already you want to stress, oh, we need to take this one and compare to the trial balance. I'm not there yet. What are you doing with this value? You just put it here, guys. You see, right there in brackets. Make sure you put it in brackets. No brackets, no marks. And now you can start comparing. You see, last year it was 97,800. This year is 95,200. It means that it decreased by how much? By 2,600. That decrease becomes income. A decrease in provision, it's exciting. It means that we predict that in the future we will write off less debt. Therefore, the decrease becomes income. We write it as provision for bad debts adjustment. Don't forget the word adjustment. Because if you don't put the word adjustment, it's wrong. You write it as provision for bad debts. Provision for bad debts doesn't go to the statement of profit or loss, it goes to trade and other receivables. Do you get it? So that word, this word here, is the one that makes it income. That's why you have to put it. And it'll be 2,600. Happy? Let's go to rent. Rent says that the tenant downsized their shop space, and as such, the rent was decreased by 1,750 per month. From 1 November 2023, the rent is received 1 month in advance. Yeah, guys, this one requires me to draw my financial year. When is the beginning of the financial year, by the way? It was 1 March 2023, right? What comes after March? January, right? It was received 1 month in advance. So this is the end. By the way, the 28th of February 2024 will be the end. When they say it was received 1 month in advance, it means that it was received until the 31st of March 2024. The reason I'm doing that in red is because it's outside. However, there was a change in rent during the year. It was increased on the 1st of November, right? So you can account the number of months over which this rent had increased. It will include November, December, January, February, March. So it was increased for those 5 months. So you're going to take that 1,750 and just multiply it by those 5 months. How much does it give you? This will give you the total amount of the increase. When it's an actual video, it's quite easy actually, right? By the way, if you struggle with this, I do have videos on rent increase and decrease by the percentage or actual amount. Just Google it there. Just go to my channel and search the rent increase by actual or percentage. Then it'll give you the examples. I like doing it this way, but most of you don't like doing it this way. I should have done it your way, but I'll do it your way shortly. Your way. You're gonna multiply this by 5. It'll give you 8,750. Your way. Now, to get your rent before the increase per month, you are going to take the rent that you have in your pre-adjustment trial balance. Normally, it will be given to you in your actual statement of profit or loss, which is this 251,250. You're going to take this 251,250 and because it was an increase, you're going to subtract that 8,750 and divide it by the total number of months over which rent was received, which is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. And just divide it by 13. It will give you rent per month before the increase. So rent per month before the increase will be, okay, I don't know if I did my calculations wrong here. Oh no, it was a decrease. My bad. It's because I was getting a decimal. So instead of minusing the total of the increase, you will add it because it was the decrease. My bad. I've been saying increase, increase, the decrease. So you add the total of the increase and you minus the total of the increase. Now the total of the decrease, we're gonna add it. So I'm gonna say 251,250 plus 87,15. It'll give me 260,000 divided by 13. It'll give me 20,000. This 20,000 is rent per month before the increase. Before this. In this case, it's before the decrease. Why do I keep on saying the increase? In this example, it will be before the decrease. It's before the decrease. And after the decrease, we just have to take that 20,000 and minus that 1,000, this amount here, 1,750, which will give us how much? It'll give us 18,250. This will be the rent after the decrease. So it'll be the rent for March, which is actually income received in advance. So we're going to take that and reduce our rent income by that and put it as income received in advance in trade and other payables. Otherwise, if you didn't want to do it this way, you could have done it this way. You'll still get the same answer. Which way am I talking about? I'm talking about it this way here. So you're going to say that before the increase, it is 1, 2, 3, 4, 5, 6, 7, 8. So you're going to have 8x. And then after the increase, it was for 5 months. So it'll be x. This was a decrease actually. I keep on saying the increase 1,750, and all of this should give us 251,250. I don't like this because it's more mathematical, and some of you didn't do math, so you kind of struggle with this. Distribute that 5 into brackets, so you will have 8x plus 5x minus, it'll be that 8,750. It will give you 251,215. And add the x's, 8x plus 5x. That will give us 13x. It'll be equal to 251,215. You will add it with 8,750, which will give you 260,000. And then to get your x, you will divide both sides by 13, divide the side by 13. Therefore, x will give you 20,000 rand. As I said, this 20,000 rand is before the decrease. You need to minus the decrease and get the decreased rent per month, which will be that 18,250, which still doesn't change the fact that it is income received in advance. Because it's income received in advance, we are going to reduce our rent income by that amount. Where is our rent income? Is right here. So you will take that 251,250 minus that 18,250, which is also income received in advance. Income received in advance will be recorded in trade and other payables as such. Deferred income or income received in advance. Done with that. Yay, that was long. And then it says an amount of 2,000 was refunded from the original deposit due to the decrease in rent. The payment has been made but not recorded. So we need to reduce our deposit. Deposit, guys, does not affect our rent. And I need to explain this, guys. When they say a tenant paid a deposit. We don't touch that deposit until the tenant moves out. We're going to use the deposit. We're going to inspect the property that we gave the tenant, check if everything is okay. If there was something that was not broken and now is broken, we're going to take the deposit to fix that thing. So monthly, does that deposit affect your rent? No, it doesn't. It just stays in an account. If there was nothing damaged, tenant is going to get the full deposit back, which is equivalent to monthly rent. Are we together? Now, in this case, that deposit, we're going to reduce it because there was a reduction in rent. So it will only affect our trade and other payables. So we will re-record it in trade and other payables annually, and therefore it will affect our trade and other payables. We need to reduce it. We write it as deposit rent income. That's what we write it as. It was 24,000, and now we're going to reduce it to 22,000. We took 24,000, we minus the 2,000. That's how we got to the 22,000. Happy? Which other account was affected? Say it was bank, guys. They said we paid for it. It was refunded, so our bank decreased. Let's go to number 8. The company has 4 directors, each of whom earn 100,000 Rand in directors' fees each year. Not all directors have been paid in full, as the bookkeeper was unsure of how the following no entries have been made. Of how to record the following. Well, that's what I missed. Yeah, English is showing me flames here. They say a director took stock with a cost price of 8,000 for her own use, guys. That affects trading stock. So you're just going to go to trading stock and decrease your trading stock. Does it affect the director's fee? No, it doesn't. Okay. I'll tell you what it affects, though. Okay. Let me continue reading. What else does it say? All vehicles. So another director was given an old vehicle with a book value of 30,000 was sold to a director for 35,000 cash. Again, guys, that does not affect the director's fee. So, guys, we have 4 directors here. That's what matters. Director's fee is about what we owe the directors, what is due to the directors, what an expense, what service, because they provided a service to us, right? And we're gonna they are entitled to 100,000 rand, and this is 100,000 rand per year. So there's 4 of them. So the director's fee is supposed to be 400,000, but I don't think we paid 400,000. Let's check how much was recorded. Now, when it comes to director's fee, they didn't tell us again how much was recorded. You're gonna go to the pre-adjustment trial balance. Director's fee, it is 312,000. You see where the problem is? That's where the problem is. It's supposed to be 400,000. So there is an outstanding amount. How much will that be? You will take that 400,000 and minus that 312,000, and then you will get the outstanding amount. You need to add it to director's fee. Okay, why is it not showing? Oh, there we go. It's 88. So that 88,000 is accrued expense. Because it's accrued expense, it will be recorded in trade and other payables as such. Got it. Then we can go to the inventory part. The inventory part means that the one director, we won't owe them that 8,000 rand because they took stock from us. So we reduce it. We reduce what we owe them because they took stock. The other one took a car, and the carrying value of the car was 30,000 rand, but the value at which that director will take that vehicle for will be 35,000 rand. So selling price will be, this will be the selling price, and this will be the carrying value. If the selling price is more than the carrying value, it means we made a profit from sale of a vehicle because we're selling it to the director, right? It doesn't matter who we're selling it to, but guys, it's just a profit. You're gonna write it as profit on sale of vehicle, which is 5,000. But this director took a vehicle worth 30,000 rand, but took it at an amount of 35. So it reduces what we owe that director. It will reduce our accrued expense. So we reduce it by the selling price of the asset that was taken. Happy now? And then it says, so in reconciling the annual stock taking figures, it was discovered that stock on hand is this. So I'm going to close my trading stock calculation there, and then it will give me a total of 8,656,000. I'm going to compare that with the stock count, which is 8,595,000. Already I can see there's a deficit here. That is because physical stock count is more accurate. What was counted as what is in the warehouse is more accurate. It means what is in the books has been overstated. We need to reduce it. When you reduce what is in the books or they adjust it, the difference becomes a deficit. And the deficit here will be 61,000. Because of the deficit, it will be recorded under operating expenses as such. Happy? Good. Packing material worth 4,000 had been ordered and paid for, but not yet delivered by the supplier. So we're going to take that and add it to, actually it was orders, but it was not delivered. So we ordered and we paid. That means, guys, our packing material is overstated. So we need to reduce it by that value. So our packing material will now be this, right? Good. Because it was ordered, but it was not, anyway, it will qualify to be, it was not delivered. It will qualify to be a prepaid expense because we paid for it, but it was not delivered, right? It makes sense, right? Yeah, thought as much. Now, let me just continue reading. Then it says that packing material used during the year amounted to that. Oh, that's why I put that 41,200 there. That 41,200 goes right, guys, here. When it comes to consumables, it can be stationery, it can be packing material, it can be cleaning material, it can be consumable stores. All of those, only the used will go to the final column. Guys, used here. Don't minus the used there, please. Just because you memorize that packing material that is in the adjustment, we minus it. No, read. If it's on hand, you minus it. If it's used, you just put it there at the end. Wait again. Away. So it means that when you find the total of the between 46,600 minus 4,000, it'll give you 44,600. So we only use 41,200. It means that the unused was 3,400. Normally that 3,400, we will put it under inventory as consumable stores on hand. Oh, done with that. Done, 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 done. A loan is repaid annually in quarterly installment of 25,000 rand each. These annual repayments, you're gonna look at annual repayments for the next year. Those will qualify to be short-term loan and they will be recorded in trade and other payables as such. We write it as current portion of the loan, which will be 100,000. We still good? A final dividend of 2,635,000 was declared on the 29th of February 2024, but was not paid. Obviously, it's final dividends, it won't be paid. So we're going to show that in retained income as recommended or declared. At the same time, it will be recorded in trade and other payables as shareholders for dividends. Oh, happy. Awesome. Then it says after the income tax was calculated, an amount of 309 was still owing to SARS. Because it's still owing to SARS, you're going to write it as SARS income tax in trade and other payables. Okay, you might as well total everything up here. Now you're going to compare this to the provisional payments. You will have noticed that I showed you when we started that our provisional payments were on the debit and it was 645,000. It means still we paid less than our tax. So our tax was over by the 309. So you will take your provisional payment and add it with the over amount that is still owed. It will give you your income tax for the year. Because we call it income tax, please put it in brackets. It's not income. It's income to sales, but to us it's an expense. People got it in brackets, please. Got it? It's an expense. Expenses go in brackets. We record them with brackets because they reduce our profits. Happy? Okay. And that is it from what I'm seeing here. Let me see. So we've got all of this. Oh, we are missing our profit after tax. It's here. So you just take it and record it here. Profit after tax. That's what you're gonna have. How do I get this one here, guys? You simply took your interim plus your final, you add them up, make sure that your dividends there is in brackets, okay? And then you just have to total everything. And total everything. Okay. It will make me start from scratch, but anyway, you just have to total everything here as well. Here as well. It will make me total everything. Okay, let me check. Got it there. Then here it's totaled. We've done this one. We've done that one. We've done the calculation. Oh, the next one is the cash flow statement. How amazing is that? So this is the information. We are required to prepare this, 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 and that. All the best. For more explanations, an exciting lesson, be on the lookout for the next lesson. Coming soon. Please don't forget to like, share, and subscribe. Hustle.